$2.4 billion. That's the size of liquidations Bitcoin just saw in the last week of September 2025. This is the largest liquidation flush since this bull market began in late 2022. The only other time we've seen a similar liquidation event was in December of 2024. If we zoom in and put Bitcoin's price on top, we see that following that liquidation, Bitcoin rallied by 15% to new highs. But that move proved to be a bull trap as price rolled over and saw a 30% crash in just the next 5 months. Today, we've once again seen nearly a 15% move up on Bitcoin following the recent liquidation. If it were to follow a similar trajectory as last time, it could take Bitcoin down to around $85,000 by February of 2026. Which would be extremely painful for investors who are positioned long. And that downside risk becomes even more concerning when we look at what long-term Bitcoin holders are doing. In the crypto space, long-term holders are investors who hold their Bitcoin for at least 6 months without ever moving or selling it. That level of commitment is not easy because it means sitting through some of the most volatile price swings of any global asset class. This chart shows what those long-term holders have been doing since 2022. When this line moves up, it signals they are accumulating Bitcoin. And when it goes down, it means they are selling. Since the past 3 months, these investors have been selling their holdings, and they continue to do so even after the record liquidation that just took place. If we zoom out and put Bitcoin's price on top, we see that these holders have a pretty strong track record of positioning correctly for Bitcoin's next move. In 2018, as Bitcoin was finding its bottom, in March 2020 during the pandemic collapse, and in late 2022 after Bitcoin had fallen by 70%, these investors were aggressively accumulating while fear was elevated. On the flip side, heading into the 2017 and 2021 bull market tops, they were heavily selling before price rolled over. While not perfect, their track record is the reason long-term holders are often referred to as the smart money. So today, we have a combination of a record liquidation event and long-term investors consistently selling their holdings. Does that mean we're seeing another major top being put in on Bitcoin? By the way, there's only a few hours remaining to take advantage of the discount that we're doing for our 5th birthday at Bravo's Research. You'll get access to our entire crypto strategy through 3 premium videos every week with real-time trade alerts, where we take you from initiating a position to booking profits and closing the trade. Our strategy revolves around making sure we maximize the size of our winners, but significantly limit the size of our losers. If you're interested, don't miss this deal using the link in the description down below. Now, we can't just look at liquidation events and what long-term investors are doing to anticipate what Bitcoin will do next. Bitcoin is first and foremost a macro asset and is significantly influenced by real-world variables that can impact its price. There are 3 major developments happening right now that can help us properly evaluate the broader setup for Bitcoin today. First is the US dollar. A weaker dollar tends to mechanically put upwards pressure on Bitcoin, given that Bitcoin is priced in dollar terms across most global exchanges. When the dollar declines, Bitcoin essentially becomes less expensive for the rest of the world to buy, which increases the demand from foreign investors. And the opposite also holds true. Historically, moves down in the dollar have coincided with rallies on Bitcoin. And dollar strength has typically led to sharp corrections on Bitcoin. So far in 2025, the US dollar is down around 12%, putting this year on track to be one of the worst for the dollar since the 1970s. This chart shows us Bitcoin's performance in relation to different degrees of dollar weakness. The data is broken into 5 groups, based on how the US dollar performs over a 6-month period. When we look at Bitcoin's returns, we see that when the dollar was at its weakest, so right here, Bitcoin returned 190%. Even when the dollar was moderately weak, we saw Bitcoin deliver around a 40% return. So if the dollar continues to weaken from here, then based on this data, Bitcoin could rise another 40% to 190%, which would put it somewhere between $150,000 and $210,000 per coin. And we do have evidence suggesting that the dollar is likely to weaken further from here. This is where the second development comes in, which has to do with interest rates. Throughout 2022 and part of 2023, the Fed had been aggressively hiking interest rates to bring inflation under control. But since late 2023, the Fed has kept rates stable and eventually even began cutting them from September 2024 onwards. If we zoom out and put the US dollar index on top, we see that While not perfect, the two lines have a close relationship. When the Fed hikes rates, it typically results in the dollar strengthening. On the flip side, when they lower rates, it coincides with the dollar weakening, and that makes sense. When the Fed cuts rates, it lowers the return investors earn on dollar-denominated assets like treasuries. And with less incentive to hold dollars, demand falls, causing the US dollar to weaken. Just last month, the Fed cut rates by another 25 basis points and is projected to continue doing so for the rest of 2025. This should put further downward pressure on the US dollar, which would be quite constructive for Bitcoin. But there is another big factor that lower interest rates influence, which brings us to the third key development called credit spreads. This is the extra interest investors demand to lend money to risky companies instead of buying safe treasuries. When the Fed lowers rates, borrowing costs across the system drop, making it easier for companies to pay back debt. That reduces perceived default risk, so investors don't demand as much extra yield. This chart shows what credit spreads have looked like going back to 2010. When the line rises, it means investors are demanding more compensation to hold risky debt, signaling growing fear in the market. And when it falls, it means investors are comfortable lending to risky companies, reflecting greater confidence and appetite for risk. If we put Bitcoin's price on top, we can see a clear relationship emerges. When credit spreads widen, it coincides with vicious declines on Bitcoin. And when they tighten, it creates an ideal backdrop for Bitcoin to thrive. Since late 2022, credit spreads have been tightening, as we can see through this line falling. Yes, there was a spike during the tariff-driven fears, but spreads have since come down to some of the lowest levels in the past 15 years. And now, with the Fed continuing to ease monetary policy, this trend is likely to persist, creating a favorable environment for Bitcoin. These three major developments we've just discussed, namely the US dollar, interest rates, and credit spreads, all fall under what's known as financial conditions, which are a set of variables that influence how much risk investors are willing to take. Given that Bitcoin trades as a global risk asset, tracking financial conditions helps evaluate whether the macro environment is supportive or restrictive for capital flowing into the token. This chart shows the National Financial Conditions Index based on data from the Federal Reserve Bank of Chicago. It tracks 105 different financial variables and combines them into a single line. When this line rises, it signals tightening financial conditions. And when it falls, it tells us that conditions are easing. Now look at how Bitcoin behaves in each of these macro environments. Periods of tight financial conditions have systematically coincided with big drawdowns on Bitcoin. Loose conditions, on the other hand, have provided the ideal environment for some of the strongest rallies throughout Bitcoin's history. Since 2023, financial conditions have been steadily easing, and they are now at the lowest levels seen in the past 5 years. In other words, we've not seen such loose financial conditions since the post-pandemic period in 2020. This has shaped our entire trading strategy at Bravos Research to position into assets like stocks and Bitcoin that benefit from this kind of a macroeconomic backdrop. So today, it doesn't seem like we're seeing a real shift in the macro environment. The very same environment that has driven Bitcoin higher is still very much intact and seems to be continuing. That's why we're not too concerned about this profit-taking chart by long-term Bitcoin holders. In fact, we can see that as Bitcoin's rally picks up momentum, these holders start to become more aggressive with their selling. So we don't view today's long-term holder selling as a definitive bearish signal. If anything, the data suggests that this kind of activity has historically occurred well before bull market tops, not right at them. By the way, make sure to take advantage of the discount we're doing for our 5th birthday. This is your last chance to secure our membership at this ridiculously cheap price. In the past few months, our crypto strategy has delivered multiple successful trades, like 30% on Bitcoin, 63% on Solana, and even 83% on Ethereum, while keeping most of our losses limited to around 5%. In fact, we've just sent out 2 new trade alerts last week. We don't do such discounts often, so if you're interested, use the link in the description below.